All right, let's get some insights in the news shaping the markets. As I mentioned, we averted a government shutdown. It was political theater until the last minutes, really, and now that gets pushed back till November 17th. Kevin Gordon's with us, Senior Investment Strategist at Charles Schwab. Great to see you.
Hey, Nicole. Good morning.
Glad you are here. You know, that political theater, I know it's political theater, but it is enough to get everybody sort of worked up because, you know, you get nervous when it gets really close, but they've averted it for now. What were your thoughts?
Yeah, well, I think the nervousness was also on the part of all these things that are facing the economy now. You've still got the strike from UAW. You kind of have, you know, still uncertainty with regards to the trajectory of monetary policy, particularly with this move up in yields that we had going into, you know, fight over the shutdown and whether that was going to occur. And more broadly, even for the equity market, I think a lot of the volatility pressure in September was the combination of that move in yields, but also the dollar and oil. So you kind of had that triple thread putting downward pressure on equity. Seems to be the case again this morning. So even though the shutdown is averted, you still have a lot of the pressure from those three forces. And I think until that abates and you start to see some easing there in rates of change in those metrics, probably keeps more downward pressure on stocks, at least in the near term. But you know, we've been saying that when it comes to shutdowns, even if you look at the past and go back in history, the average move for the S&P 500, as if you want to use that as the benchmark, from beginning of shutdown to the end is just 0.1%. So you can almost look at that metric, that average alone, and say the market doesn't really care that much. So I wouldn't use this as some sort of, you know, trading mechanism or anything to sort of look and affect your long-term outlook.
There was talk that the economy could slow if the government shut down.
Absolutely.
Also that the Fed wouldn't get the data it needed to make its next decision in November. But as you said, we've made past and we're not getting much movement. We haven't gotten much movement, so that's some good news. This week we'll get ISM, we'll get manufacturing and services and jobs. Anything that you're really looking for or a theme that you're expecting?
What was interesting is that manufacturing this morning was actually a lot better than expected. You had a nice turn in new orders, still in contraction, but at 49, you know, you're definitely starting to look like you're carving out a bottom. Employment jumped back. Employment jumped back into expansion. You had production doing better, prices paid move lower. So actually, in terms of trends, everything was exactly in the right direction that you would want to see. It was probably, you know, a little bit hot for some areas like employment that the market's not looking for in terms of, you know, the good news being bad news from the Fed's perspective. But I think a lot of that probably shifts attention to services now this week, whether you are going to get more of a hit, some more easing in services, which has been our expectation because as manufacturing starts to turn up a little bit, you know, that was one of the first sectors to enter its own little recession that we've been calling, and then now it's starting to turn higher. Services hasn't been hit that way yet. So ideally, you don't get a contraction in services. That would kind of stabilize things. But I would be on the lookout for some of the weakening trends in that area.
So we'll watch for that. And then as far as revenue growth, you're looking for that. These companies have been cutting costs, but you can't cut costs forever. You really have to have intrinsic organic growth.
Absolutely.
Right, in the company.
That's the key for third quarter earnings. I mean, a lot of people are asking what's the stabilization that you get in markets for the fourth quarter as we turn the corner into the end of the year. I think, you know, as I mentioned with the triple threat of the dollar, oil, and yields earlier, you need a stabilization there, but you also need third quarter earnings season to show up in the way of revenue growth, not just earnings. Because like we saw in the second quarter, if you have really great earnings growth, but deteriorating revenue growth, that mix just means that you're achieving that because of aggressive cost cuts. That doesn't work in perpetuity. So you need to see revenue come back and more of a stabilizing there. And I think the jobs report this Friday probably holds a lot of the keys there because if you have more of a downtrend in certain sectors, that sort of, you know, supports the notion that there is more aggressive cost cutting going on.
And then, what are you hearing about the Fed and also Santa Claus rally? Some of the things people are just sort of talking about and looking to.
Yeah, I mean, I understand the desire to want to point to seasonal factors, you know, to support the market going into year end. You had September that was weak, consistent with history. It's the weakest month of the year historically.
Not generally pretty great either.
Exactly. So I think, you know, if you want to not ignore the seasonals, but don't use that purely as a trading mechanism, which is, you know, our team doesn't. You want to look at breadth statistics and whether there is improving, you know, participation under the surface of the market. You're entering this period now where 40% of S&P 500 members are above their 200-day moving average. That's a pretty weak setup. But I think much like you saw from March, April, carrying into the summer, where the S&P 500 at the headline level started to move higher, and you eventually got that participation and breadth, that was a fairly good setup into midsummer. That was obviously cut short because we had a pretty weak August and September. But if you can get that setup and that nice trajectory, I think it probably gives you some more room to do better at the end of the year.
So at this point now, most of the sectors were to the downside last week. So you can't, technology actually squeezed out a gain. And that was the darling of 2023 when we kicked off. I mean, anything when it comes to sectors for investors or advice to investors?
Well, what's been interesting since the July peak for the market, the only sector that's up and the one that's been defensive has been energy. And I think, there's a two-sided story, two-part story where obviously the run-up in oil prices has helped, but at the same time, energy scores really well in terms of interest coverage. So if you think about their earnings relative to their interest payments, they're doing really well, meaning they can cover everything, and all the pain that comes from higher rates. Can't say that for every sector. Actually, for something like tech, the interest coverage ratio has been in a downtrend. So I think that's one of the key differentiators in this market where, you certainly have some tech names that have done really well year to date, carried the index higher, but, it's not the only sector in town. And tech has, one of the worst performing backdrops since July, even though it did eke out a gain last week. I think you want to pay attention to some of the factors under the surface and use factors and characteristics, not just sectors, when you're looking at parts of the market to invest in and how to stay defensive.
And then at the same time, in Barron's, they were talking about not to worry less about the government shutdown and more about the deficit. And that the deficit is problematic.
Well, it's one of the things.
Picture, right?
I think it's one of the things from a rates perspective. When you look at the run up and you see how much interest expense is rising for just the country overall, it's one piece of the puzzle for the move in rates. And it's not just a U.S. centric story. I mean, this is a global move that you've seen in yields. You can pick any developed country, even for some emerging countries, this has been the case. But I think at least when you're looking at the at-home situation, the deficit is probably one thing to consider and a piece of the puzzle long term.
All right, Kevin Gordon of Charles Schwab. Thank you for being here. Great to see you, Kevin Gordon. Thank you.